Welcome to The Explainer. Today, we're going to pull back the curtain on the hidden rules that shape billion-dollar commercial real estate deals. We're talking about the crucial promises that hold these massive transactions together, and we'll see how it's really a tale of two very different kinds of capital. So, let's kick things off with a simple question to get our heads in the right space. Imagine you give a friend $100. Now, if it's just a loan, you really only care about one thing, getting your $100 back, right? But what if it's an investment in their new business? Suddenly, you're not just thinking about getting your money back, you want a piece of the action, a share of the profits. The kinds of promises you'd ask for in those two situations, totally different. And that's the perfect way to think about what's happening in high-stakes real estate finance. And this gets us right to the heart of our topic. In the world of commercial real estate, these promises, these rules of the deal, they have a specific name: covenants. At its core, a covenant is just a formal promise baked right into a contract. Its entire job is to protect the people putting up the money by setting boundaries on what the property owner can and can't do. You can think of them like the guardrails on a highway. They're there to keep the deal from veering off course. Now, at the deal table, you've basically got two main players shaping these rules. First, you have the lender, the one providing the debt. Their whole world revolves around capital preservation. Their mindset is, how do I not lose my money? Then, on the other side, you have the investor, who's putting in the equity. Their goal is all about maximizing returns. They're constantly asking, how do we make this investment grow? And these two totally different mindsets, well, they lead to two very different sets of rules. Okay, so let's put ourselves in the lender's shoes first. For them, the game is simple. Make sure the loan gets paid back. Period. Their entire strategy is built around playing defense. This quote right here, it's basically the lender's mantra. Every single covenant they write, every rule they put in place, is designed to prevent a loss. See, they don't get to share in the profits if the property's value goes through the roof, so their only focus is protecting what they put in. A key tool in their arsenal is something called the debt service coverage ratio, or DSCR for short. This little calculation is a vital sign for the property's financial health. It answers the lender's single most important question: is there enough cash coming in from the property to actually pay the mortgage? And here's the thing: lenders aren't happy with just breaking even. They demand a cushion, a financial buffer. A really common floor is a DSCR of 1.25x. That means for every single dollar owed on the mortgage, the property has to be generating at least $1.25 in income. If that number drops, that's a huge red flag for the lender. Next up is the loan-to-value ratio, or LTV. This metric is all about limiting the lender's exposure. So if a property is worth $1 million, a lender might only loan, say, $700,000 for a 70% LTV. This makes sure the owner has a lot of their own money, a lot of skin in the game, which makes it much less likely they'll just walk away if things get a little tough. But it doesn't stop there. Lenders build this whole fortress of other protections. They might set up a lockbox, which means all the rent checks go directly into an account they control. They'll definitely require the owner to set aside cash reserves for future stuff like taxes or a new roof. And you can bet they'll have rules that say you can't just sell the property or take on more debt without getting their permission first. Okay, so we've seen the lender's defensive playbook. Now let's flip the table and look at things from the equity investor's point of view. They put their cash in to get a piece of the profits, so their entire strategy is about maximizing that upside. For equity investors, it is a totally different ballgame. They're focused on alignment, making sure the operator is motivated to make the money. They're focused on governance, having a say in the big decisions. And they're focused on hitting specific return thresholds that make the whole investment worth it. This all starts with a really important rule called the preferred return. This is a critical covenant that basically guarantees investors get paid first. It says, hey, before the sponsor or the operator gets their big performance bonus, we, the investors, get our cut of the profits. So, for instance, an investor might demand an 8% preferred return. This is a hurdle. It means they're guaranteed that 8% annual return on their money before the sponsor can start taking their share of any additional profits. That threshold has to be cleared first. And this all fits into a structure with a brilliant name: the distribution waterfall. It's a sequence that lays out exactly who gets paid and when. So think of it like this. First, the cash flow pays back all the investors their initial capital. Once that's done, the next bucket to get filled is their preferred return. After that, the profits flow down through more tiers, getting split up between the investors and the sponsor according to a very specific, pre-agreed upon formula.
So, the crucial point here is that investors are not silent partners, just hoping for the best. No way. They demand a seat at the table. Their covenants give them veto power over all the major decisions: selling the property, approving the budget, taking on new debt. This is how they protect their investment and steer the ship from the inside.
All right, let's put these two playbooks side by side, because when you see them together, the fundamental clash between these two types of capital becomes crystal clear. I mean, look at this. It's night and day. Debt covenants are all about downside protection. They are rigid, legally binding, and super restrictive. And if you break a rule, the consequences are severe. We're talking foreclosure or the lender seizing all the property's cash. On the flip side, equity covenants are about alignment and capturing that upside. They tend to be more flexible, and if there's a breach, the remedy isn't to seize the property. It's more like removing the manager or cutting off their profit participation.
So, why are we digging into all this right now? Well, because the strictness of these covenants, it acts like a barometer for the health of the entire commercial real estate market. You see, these rules change depending on the economic climate. In tight credit markets, when money is hard to borrow, lenders call all the shots. They demand stricter rules, lower leverage, and more cash reserves. But when markets are flush with cash and lenders are competing for deals, you start to see these covenant-lite structures appear, where borrowers get a lot more flexibility. Which brings us to today. Right now, we are absolutely seeing a return to more conservative, back-to-basics lending. After the recent shocks to the system, lenders are tightening the screws again. They're focusing hard on metrics that prove a property can actually pay its bills, and they're looking very closely at whether the sponsor has enough cash to weather a storm. For now, the covenant-lite party seems to be over. And this all leaves us with the ultimate challenge, the billion-dollar question that everyone in a deal has to answer. How do you write rules that are strong enough to protect the capital without being so tight that they strangle the business and prevent the property from actually succeeding? Finding that perfect balance? Well, that's the art of the deal.